question was, the dealer that Bill was referring to was accelerating the depreciation on the assets that the store had. Is that the question?
Yeah.
Let me explain, first of all, what depreciation is or what it's supposed to be. From a theoretical standpoint, it is, you've got all these assets on the books. You've got equipment in the shop. You've got the facilities sometimes on the dealership's books. You've got all the furniture and fixtures. You've got all the computers, all this stuff that the dealerships bought. All of that stuff wears out, right? You got to replace it periodically. The computer system lasts 5 years. You got to replace it. The shop equipment might last 15 years. You got to replace it. Depreciation is supposed to be, in theory, the wearing out, the expensing of the wearing out of that equipment. Does that make sense?
Yep.
And in a theoretical basis, what you would do is take every asset in the dealership, every single one of them, make a list of them. You'd know what the cost was that you had. Tag them all. So if somebody runs off with it, you can write it off. If you need to replace it, you know what you're replacing. You tag all the assets, you go through, and we have literally done this. We've had an engineer walk through before and give us an estimated life on the remaining life of that asset. Or an equipment guy can do it, a used equipment sales guy that calls on your store. They can walk through and say, that lift's going to last you 10 more years. You shouldn't have to overhaul it for then. And then you would theoretically, if it's a $1,000 lift, you'd write off $100 a year for 10 years to show the wearing out of that lift. That's the theory. Now, what's the difference between that and accelerated depreciation? Okay, the tax law says that if you buy a lift, it is depreciated. I don't care how long it lasts you, it's going to be depreciated over 7 years. Period, end of discussion. If you buy a computer, it's 5 years. End of discussion. It might last you 3, it might last you 7, but you're going to write it off for tax purposes over 5 years. In addition to that, if you buy less, and I don't want to get too complicated, but if you buy less than $50,000 this year, you can, if you go out and buy $125,000 worth of equipment, you can write it all off at one time this year. So if the only adjustment that's being made is the tax depreciation, it's got nothing to do with the wearing out. It's what the IRS says you have to do. And if you set your depreciation up on a tax basis, you'll expense just about all the equipment at one time. $125,000 worth in a year, plus any other depreciation. Does that make any sense? It's got nothing to do with reality. It's got to do with what the IRS has to say if that's what they're telling you, if that's what you're doing on your books. And a lot of times there's only one depreciation schedule. It's the tax depreciation schedule. And you just book that tax entry at the end of the year. So you're expensing all of this stuff that's really got a lot of value left on the dealership, but you've expensed it. Does that make sense? A little bit? I know it's esoteric a little bit, but that's what's going on.
So the question that we have right here, you said a computer can only be depreciated over 5 years. Is that
for tax purposes?
For tax purposes.
Now, if in reality I've got to replace this laptop every 2 or 3 years, the daggum thing breaks, it wears out, the software is obsolete. So for book purposes, I'm going to depreciate this thing over 3 years. I'm going to reflect the wearing out. If this is a $3,000 computer, I'm going to take $1,000 a year for 3 years and expense it, because that's how it's wearing out. For tax purposes, though, I got to write it off over 5. Crazy? That's how it works.
And when we write a check for those equipment, we are writing a check. We are taking that cash out of that business and writing a check. Now, in spite of the fact that it could be just $100 a month, we already wrote a $2,000 check, and we're out $1,900.
But it doesn't show up on the P&L.
Which is the profit and
the profit and loss. It does not show up in, when you write the check to buy an asset. Okay, this is, I didn't think we were going to get this deep today, and if I get too deep, stop me, okay, because I can talk about this stuff all day long. The point I was trying to make is if you go out and buy an asset, a piece of equipment, a computer, or a table, it doesn't hit the P&L that month, okay, typically, unless it's a very insignificant item. What happens is it goes on the balance sheet, gets added to all the other assets the dealership owns, and then we use the depreciation to show it wearing out. Does that make sense? So it hasn't impacted the net profit Bill was talking about. It doesn't affect any of that stuff.
Why is it important for a sales manager to realize that? Because at one point, you can look, some of the sales managers are privileged to what the dealership is making and not making. Mm-hmm. And they look at the financial statement and they said, well, man, this dealer just like made 80 grand. I wish he could stop just taking money out of the dealership. He's always telling us, where's the cash? Bring me my contract in transit and do this. We all know most dealers actually don't take cash out of the business. They keep it there because the more cars you sell, the more money you need, and we're going to get into that a little bit.
Yep.
But as you are buying assets, You're paying cash for them. You're depreciating them over 2 years, and you only have to buy a few assets. Next thing you know, that $80,000 profit, you're in the hole. And that's why the dealers are always saying, get me paid. Collect the money, and when you're done, please collect the money. So you as sales managers and finance directors and general managers and glorified F&I directors and all that good stuff, if you are a team member, if you're a team player, what should be your number one goal to do?
Collect the money.
Collect the money.
Guys, turn the page, if you would, to page 185.
I did have one question.
Yes, sir.
On that 2% net profit, what is the what should an average dealership be doing? I
The
mean,
average
about
dealership
1%,
right now is
2%?
doing a little less than 2%.
Okay.
Closer to 1.5%.
Okay.
But it's seasonal also. You know, most
Sure.
dealers are not making as much money right now as they make when the weather gets warmer. That's just the nature of the business.
What about a dealership that's like a well-oiled machine? I mean, just on top of their game and just slaying them, like 3%, 3%?
Well, the NADA guide is 4%.
Okay.
Okay. Pardon me? What's the benchmark? 4%. 4%.
Bill, does that depend
And
on
we
the
have
franchise?
we have dealers that are doing better than that. Dealers are doing worse than that. But it's a tremendous give and take between the amount of gross that you generate and the amount of expenses that you have. And that's why you see so many dealers are so concerned about their expenses, because what can kill a dealer, and as an example, let's say you have a 20-car weekend. And you have hold checks, and you have cars out, and you traded in cars, you don't have titles. You could have made, let's say, $40,000 that weekend, let's just throw it as an example, and be $100,000 in the hole cash-wise.
Good decision, Jason.
That's why a dealership has to have a large amount of cash at all times in order to stay in business and stay viable.
Bill,
Yes, sir.
if you're ultimately, let's say that a dealer's got 3 to 5 franchises, and you were going in taking that operation over, and you were going to do a line by line, knowing that it could take you 45 days to really get a good grip on it. What would be the first 2 areas that you would go to make an immediate impact the first 30 days?
Okay. What are the 3 largest expenses in any dealership? Maybe this will be your answer you're looking for. Payroll, personnel, right, is 1. Marketing, advertising, number 2. I'm not saying these are it may not be number 2 in every store, but these are the top 3. Payroll, personnel, advertising, marketing, and floor plan. Why do you, and 20 groups is an example, we have dealers that get very upset at other dealers because they feel like he has an unfair advantage because he owns all of his inventory and he's paying no floor plan. And of course, you've got to play the game now with the factories and the manufacturers that you've got to get your floor plan credits. You don't order enough cars, what happens? You don't get your credits. You order too many cars, what happens? Now you get overage inventory, and you don't order enough cars again. It's like a dog chasing its tail. It's very difficult. I had a Chevy dealer 3 years ago in one of my large Chevy group, and these guys were big dealers, making millions in their stores. And I said to him, I said, Howard, do you realize that your advertising credits and your floor plan credits represent $200,000 a month in income to your store? He said, no, I didn't. And I said, what's going to happen to your store when you don't have those credits? That's $2.5 million a year. He's since sold that store.
Part of the problem, too, is that you cannot see those credits on most manufacturers' financial statements.
Yes.
They're netted against the expenses.
Now, as a good car guy, we always try to pay attention to used car aging units and all that. And, NADA comes up with 30 days, 60 days. They cannot make up their mind yet. Right, Bill? What is it right now?
Well, they say 30, I say 60.
30, 60, and we were at close to 11% at the store that we were running. And with new cars, a lot of the dealers just ignore them. They don't think of new car aging inventory. They leave that alone. They say, well, it's from the manufacturer. They gave me floor plan credit. Just keep stacking them. Keep ordering them. The more, the better. As a matter of fact, I want to go ahead and take a picture and show everybody how much inventory I got. Man, I wish I was that naive and happy at the same time. New car inventory needs to be turned around as well. And almost you have to be very aware as a manager to say which car got ordered first. So that's the car that you sell first. Because as it sits on the lot, what else happens? Everybody at the same time. Lot damage, correct? And then there's something else where the bank comes in and say, hey, you've had this car too long, write me a check. And that goes from where?
Right out of the bank account. Cash.
Right out of the bank account. And when the dealer doesn't have a lot of money in the bank account, are they ready to write a bonus check, Bill, or are they ready
No.
to cut a pay
Answer-
plan?
Yes, that's right.
So, by the way, what's the highest you've seen? Where is Lexus at net to profit?
About 4%.
How dependent is it, Bill, on franchise? How dependent is the net to sales based on franchises?
Well, I think right now, these things change. When I started with 20 Group 12 years ago, we do what's called an array of profits. And that's based on the percentage return on sales by manufacturer. And the left side of the bar, as you would be looking at it, would be the highest guys. The right side would be the lowest. 12 years ago, the highest part of that was Ford, General Motors, and Chrysler were over there. Lexus, Infiniti, Nissan, Toyota, all of them, Honda were on the right-hand side. They were nowhere at that time. Now it's totally reversed. Now Lexus, year in, year out, is the bomb. I mean, it's ahead of Mercedes, it's ahead of BMW in terms of profitability. But the caveat in that, though, is that most of the Lexus dealers don't sell as many vehicles as the larger BMW and the larger Mercedes stores do. So that's where that comes, because you may look at a Lexus dealer might be making, let's say, $250,000 profit on average in a month. And you look at a Mercedes dealer or a BMW dealer, and they'd be making $1 million a month, even though they're making more in return on sales. And that's where you get back to the old return on, what's the return on investment or return on sales? Last year, the average Lexus dealer made $8.5 million.
Yeah, baby.
But there's not a lot of them out there. So that's not where the opportunity lies for most people and most dealers. Last week I was with the Ford Group as an example, and to give you, they're the number 2 rated Ford Group that we have. They're rated number 7 of all of our 20 groups, which is shocking to a lot of people that the domestic dealers are making money, and they are. I mean, they're by and large they're doing pretty well. What they've done is they've changed their business model dramatically from what it used to be, and we don't have really time to talk about that today. But in talking about inventory, we had one of our dealers he was an excellent dealer. He's out in the middle of nowhere in Iowa. He's got a big old Ford store sits out there, and they make over $1 million. They make $1 million to about $3 million every year, come rain or shine. The guy that's the general manager of the store is really not a car guy. I mean, he came up through Universal Underwriters and that, but he's a good businessman. Really understands the financial statement and that, but he could not get his arms around generating gross. And it was like, I had conversations after conversations with him over the years. Last year, light finally went on. In 2006, they sold over 1,200 used cars at a loss of $280,000. What is the point? Last year, he sold 770 used cars at $300,000 profits. That's almost a $600,000 turnaround in the used car department. He shut down they had lesser volume, they carried fewer cars, and started selling cars for subpar growth. They're still selling them for like $1,500, $1,600 a copy. They were selling them for $700, $800 a copy. He couldn't make any money. And I remember I embarrassed the guy at one of the meetings. I said, you keep this pace up, the more cars you sell, the more money you're going to lose. Where's the business model here with this thing? And he got mad, and finally they made up their mind. They changed their packs. They changed their buying process. They changed a lot of things which they needed to do. Anyway, I'm getting off the subject when I talk about
No,
this.
you're not, because one of the things that you do at a 20 group, which is, it's not an invitation or a advertisement for a 20 group, but this is the kind of stuff that dealers at this time need. In the past, they say that being a dealer or being a general manager is the loneliest spot on earth. 10 years ago, 15 years ago, the buck stops here, you're at a desk, every decision you make is under a microscope. You make the right decision, the wrong decision, there's 15 people to judge it different ways, correct?
Absolutely.
This time, in my opinion, I believe that this is the best time to be in the car business. Never ever before we have had more opportunities and more people that know what they're doing, prudent business practices that is proven and is backed up by an incredible track record with an incredible amount of knowledge that has been based on tracking many, many, many different operations. So it's not a theory, it's not a concept, it's absolutely a proven fact. And for dealers to say, well, I just don't know how to do this, all that means is you have not taken the time to go seek that knowledge or ask that advice. And you don't necessarily have to go and ask your next door neighbor for that advice, because he won't give it to you unless it's me, because I'll give it to you anyway. Bring it on, you know. On the other hand, you can go to a 20 group meeting where there's several dealers out there, correct? From all walks of life, from all kind of different zip codes. You can contact a gentleman like Mr. Porter, who has been in probably 100 dealerships in a year, and he can give you a few things. And you need somebody like Bill. Well, he's really not in a popularity contest. He'll probably get you more upset than happy most of the time, but he'll tell you the truth.
Supposed to. Supposed to.